Welcome back, everybody. American Express just had Q3 earnings where they had their sixth consecutive quarter of record revenues and topped estimates. So naturally, the stock dropped 5% that day and is down over 9% over the past 6 months. And as investors, sometimes it's hard to understand why these things happen and what's going on. So in this video, we're going to break down American Express's Q3 earnings compared to their own 2023 forecast, dig through some analyst commentary to figure out why there's confusion about the stock, and talk about the issue that I think is actually causing American Express to keep going down. Now, if you watch this channel, you know that I hold American Express in my own portfolio, and it makes up about 10% of my total holdings, which to me is a pretty significant amount. So anytime a stock that I own goes down 5% in a day after earnings, it piques my interest. They must have had a bad quarter, right? Well, not really. Amex beat on top and bottom lines with revenue that was $15.38 billion, up 13.4% year over year, and it was their sixth consecutive quarter of hitting record revenue. And they had earnings per share that were up 34% to $3.30 a share versus a $2.95 a share consensus estimate. And listening to some commentary about their earnings actually gave a little bit of insight as to how they got there from a revenue perspective.
You take a look at some of these other drivers here for the quarter. When it comes to that revenue growth there that I just mentioned, that was helped in part by a massive increase that we saw from the company in terms of credit card fees. They raised that by about 20%. And putting that in perspective, for everyone there at home, fee cards accounted for more than 70% of the new accounts there at American Express in terms of how much people are paying. Their Platinum card, the annual fee there, $695. They've also been adding some more perks to some of their other fees. The Business Gold card fee there rising to $375 from $295. But when you take a look at the spending trends that we're getting here in this report, it points to what we've been talking about now time and time again, that the consumer is still out there spending. And this is certainly a look more so at the wealthier type of customer here, but certainly does show that the consumer remains resilient.
Now, as an investor, what I like to hear in that clip is that one, of course, Amex's core customer is still spending. And part of that may be just resiliency of consumers overall, but Amex's core customer also tends to be wealthier. Plus, her discussion on the 20% increase in card fees shows that Amex has pricing power, which you know is a critical component to the type of companies that I like to invest in. Now, let's take a look at how the results for Q3 and the rest of the year have actually compared to their 2023 forecast. And we talked about this recently in the Starbucks video about judging companies based on the guidance that they give us, and not based on what analysts or the headlines say. And if we look at what American Express's forecast was compared to their year-to-date results, we see that they've actually done pretty well. In their last annual report, they had 2023 guidance as follows: 15% to 17% revenue growth, and $11 to $11.40 earnings per share. And now if we looked at how they performed so far in 2023, in Q1 they had revenue growth of 22% and they had earnings per share of $2.41. In Q2 they had revenue growth of 12% and they had earnings per share of $2.89. And then in Q3, they had revenue growth of 13% and they had earnings per share of $3.30. And now you might notice in the last 2 quarters, their revenue growth was actually under their 15 to 17% target range. But if we look at their year-to-date numbers, we see that so far all in, they're at 16% revenue growth, which is right in the middle of their forecast. And if we take the earnings per share number, so far in 3 quarters of the year, they're at $8.60. And if we extrapolate that over the 4 quarters, they'd end up at $11.46 per share, which would be above their $11 to $11.40 guidance. So again, just like in the Starbucks example that we talked about, American Express provided their forecast last year, and at least so far, they've hit their numbers. Now, you could argue that since their Q2 and Q3 revenue growth numbers were below their range, that maybe it's that decelerating revenue growth that the market's actually reacting to, even though they're still within the range of their full-year forecast. But another possibility that people have been talking about is the increase in loss provisions.
One of the other things here, second thing that caught my attention, is they moved higher their total provisions for credit losses here, and that's up by about 58%. I imagine the street might be paying some attention to this here because as that sits at about $1.2 billion for this most recent quarter, 58% move higher in what they're expecting for some of those credit losses here. That is a significant number to keep a close eye on as well here. So
people are mentioning a 58% year over year increase. And of course, when you see that number, it looks like a lot. But putting money away for potential losses is something that Amex and just about every financial service company has been doing to prepare for a downturn in the economy. So while looking at this number year over year might be helpful, it makes a lot more sense to look at it on a quarter over quarter basis so we can see how it's been building up over time. And as you can see, Amex has been ramping up provisions for losses since Q4 of last year. So while they may be up 58% from Q3 of 2022, they're only up an additional 2.9% from what they had just last quarter, which is hardly a huge change or cause for concern. And remember, provisions for credit losses are just good planning. Now, obviously, people take it as a negative signal because the company's planning for higher potential losses, but it's good to keep that into perspective. And one of the ways that people monitor this is through delinquency and charge-off rates. And in case you hadn't heard those terms before, let's define them real quick. Delinquency rate is the amount of debt that is past due, so it represents the percentage of their credit card loan balances that aren't current. And charge-off rate is the amount of debt that's actually been defaulted on, so it represents the percentage of their balances that they'll have to write off as a loss. And if we take a look at the delinquency rate trend on the Fed website, we see that it's trending up this year to an average of 2.77% in Q2 of 2023, and that's up from 1.57% in Q4 of last year. And I'm guessing that number is going to be even higher in Q3. And when we break down the August data between actual financial companies, we see that there's quite a bit of difference in what they're seeing. You have companies like Capital One seeing delinquency and charge-off rates greater than 4% and higher than what they were pre-pandemic in August 2019. And when you look at Discover, they're seeing a similar trend as well. But when you look at American Express, they have some of the healthiest percentages on the list with only a 1.2% delinquency rate and a 1.7% charge-off rate. And both of those numbers are actually still below their August 2019 pre-pandemic numbers. And even the updated data from American Express in September was basically the same, with delinquency rates up slightly to 1.3% and charge-off rates the same at 1.7%. So what that tells me is that Amex has a customer base that, at least for now, seems pretty healthy. They're still spending, they're paying higher card fees, and they have some of the lowest delinquency and charge-off rates out there. So overall, I think it looks pretty good. So any additional provisions for losses that they're doing, I would just look at as good planning, and it's not something that I would really be worried about, at least in my opinion. But I think one of the biggest issues with American Express is that people misunderstand what type of business it is, so their expectations for the stock are a little off. And we see this often as it relates to comparing American Express to Visa and MasterCard. And I get asked about this in the comments all the time. And if you remember in my Visa video, I said this. So believe it or not, American Express and Visa aren't as direct competitors as you might think they are. So Amex obviously has a network, but they're also an issuer and a banking provider that gets interest income and has default risk for the credit that they lend out. So they're more like a bank that operates a closed loop network for their cards. Whereas Visa is a payments infrastructure and technology company who process transactions but don't actually take the credit risk that the card issuers do. But even if you're watching the financial news, people are talking about them in the same way, which can be confusing for all of us.
Landon, when we talk about Visa and MasterCard, we almost have a Boeing Airbus discussion like that. But really, American Express is a major player in this. But why do you think they're not mentioned so much? Is it because they hold the balances that Visa and MasterCard don't handle? Because their valuation is half what these others do. The PE of American Express right now is just over 15. Visa, 30. MasterCard, 36. So what is it that's making them? Because if there's bad news, if there's suspected bad news in the future, Landon, it's all baked into this stock already.
I agree. I think I agree. Look at the valuations. It doesn't make sense. You can argue about how many customers they have and what they spend and all that. But the PE ratio, just like you pointed out, that's the key. And to be half of its competitors really, to me, just says that there's so much bad data priced in, and we don't see any bad data.
And actually, here's a place where my 10 plus years working in payments helps me understand the stock better. There's a reason why Amex isn't as a direct competitor to Visa and MasterCard is because in their business model, they're a card issuer, a card network, and a merchant acquirer. And when you look at Visa and MasterCard, they're basically the card network, but they don't do the issuing or acquiring part of the equation. And now I'm grossly oversimplifying what these multi-billion-dollar companies do, but just bear with me. Because Visa and MasterCard are payment technology companies that provide specifications and a payment network for transactions to process on. Issuing banks partner with them to issue their cards, and acquiring banks partner with them to offer payment services to merchants, which in the simplest form is basically the little terminal you use to check out at the store. So the beauty of Visa and MasterCard's business model, which I talked about in my Visa video, is that they don't take the risk of credit losses, and they don't deal with interest rate risk or any of those things that a normal bank would have to deal with. What they do is process transactions, and a lot of them. It's part of why their profit margins are so high compared to other companies, because their business model is built that way. And it's part of why I love their businesses so much and why they trade for such a premium. So comparing American Express trading at a 13 PE ratio versus Visa trading at a 29 PE ratio and MasterCard trading at a 35 PE ratio makes no sense because they're different business models. Now, American Express is also a card network, so part of their business model is like MasterCard and Visa's, but a bulk of the revenues are coming from the issuing and merchant acquiring side of their business, which Visa and MasterCard don't have. And those parts of the business come with additional risk and regulations because they're the type of things that a more traditional bank would have to deal with, which we're going to talk about a little bit more here in a minute. So if you look at Amex in those terms, you realize that comparing their PE ratio to Visa and MasterCard really doesn't make a lot of sense. And look, I've made this mistake in the past too. Like, we're all learning as we go as to how to best value these companies. But if you compare Amex to other banking institutions that also have cards, you see that their price to earnings picture looks a little bit different. Capital One, Discover, JP Morgan all have PE ratios under 10. So Amex trading at around 13 is actually at a premium to those companies. And I think that's because, again, their business model is a mix between the banking model and the card network model. And so when we look at Amex from that lens, the valuation starts to make more sense. And I actually think that's part of the reason why it's been down so much over the past 6 months. Let me explain. So back on July 27th, the Fed issued a request for comment on new proposed rules to strengthen capital requirements for large banks, and everyone's calling it the Basel III Endgame proposal. And while there's a bunch of stuff in there, the important part for this video is that they want to raise capital requirements for banks above $100 billion in assets, and apparently in a way that is above and beyond what other global banks are being asked to do. So effectively, this means that any bank that's going to be impacted has almost immediately become less attractive to investors because they're going to have more capital requirements put on them, which limits the amount of capital they can either distribute to shareholders or invest back into their business. So obviously, this isn't a real popular thing with the banking community, and Jamie Dimon, the CEO of JP Morgan, has already come out saying that this will potentially make U.S. banks uninvestable. And one thing that's interesting is that if we take a look at some of these bank stocks that are likely impacted and see how they've performed since this was released, they're way underperforming the market. And to show you what I mean, first off, let's take a look at how they were doing before this was announced. So basically, from January 1st to July 27th. You see the S&P 500 was up 18%, Amex was up over 11%, Discover 7%, Citigroup 4%, Capital One over 22%, and, well, you had Fifth Third when really they're the only outlier, which was down quite a bit. But then if we look at the same stock's performance since July 27th of this year, the S&P is down about 7%, Amex is down even more, over 11%, but then if you look at some other similar banks, you see it's even worse. Discover's down over 20%, Citigroup over 18%, Capital One over 20%, and Fifth Third over 19%. Now, obviously, there's other things happening in the market with interest rates, and we had the banking crisis earlier in the year, and there's global conflict, so it's probably not all this, but it is a pretty big coincidence that they all really underperformed the market since July 27th. And just to compare against the other card networks, we can see from January to July 27th, Amex was actually performing pretty close to Visa and MasterCard, lagging a little bit behind, but in the ballpark. But then if we look at how Amex has performed since July 27th, we see a totally different story. So again, I think this helps to show the real difference in business model between Amex and Visa and MasterCard because they're dealing with risks and impacts that the other card networks just aren't. And even if it's not all related to the Basel III Endgame proposal, it would at least explain why Amex is in a downtrend even though their year-to-date performance has been pretty good. Because if investors think that their overall business model and available capital is going to be reduced due to new regulatory rules, then they could be adjusting their future growth and earnings outlook for Amex and basically selling off. And to me, that seems way more reasonable than anything related to loss provisions or a slowing economy because those just aren't showing up in the numbers yet. Okay, but what does this actually mean for us as investors? And just right off the bat, the real answer is we don't know. I mean, this is still in the comment period, and we don't know what the final rules are even going to be. And the comment period is lasting until November of this year, and they're targeting full implementation in 2025. So it might be a while until we see the full impact of this or even know what the real requirements are. But I still think it's a risk that's worth evaluating if you hold any financial stocks that could be impacted. And for Amex, I think they're kind of in a unique position because they are a blended business model, and I think you see that in the stock performance and valuation. Because their PE ratio is lower than Visa and MasterCard, but then it's higher than all the other bank stocks. And even as bank stocks have sold off since July, Amex has gone down a little bit less than the other ones have. But I also think it says something about the quality of American Express as a company as well. because American Express has a strong brand and a long history of performance. They have demonstrated pricing power in their products. They have a wealthier customer base that, at least for now, is continuing to spend and pay their bills, which shows up in them having one of the lower delinquency and charge-off rates compared to their peers. So all those things I think are really attractive, and I think it makes it obvious that if you're going to invest in a financial company, American Express is really one of the absolute highest quality companies you can invest in. But the question is going to be whether or not new regulatory requirements are going to make investing in all banking companies just completely unattractive to investors. So obviously for me as an American Express shareholder, this is something I'm going to be watching very closely. But at this point, there's just not enough concrete information for me to make any kind of informed decisions on, at least at this point. So at most, if you haven't bought into any of these companies yet and you're worried about it, maybe you hold off until there's more clarity. But for me personally, I think Amex is such a high quality company, and in general, they're positioned pretty well. So I'm not going to panic, and I'm just going to see how it plays out. So what do you guys think? Is Basel III Endgame really a catalyst for these prices, or is it something else? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins. And I'll see you guys in the next one. Peace.